Okay, guys, PayPal just reported a lot of fluctuations in the minutes after they reported. In this video, guys, we're going to go over PayPal. We're going to go over some news on them, some analyst estimates, our 8-pillar process, stock analyzer tool, and full disclosure, I own PayPal. I absolutely own PayPal. You should not own it just because I do. That's the last thing in the world that you should be doing. We're here to try to teach a process, and when we teach the right process and you learn that process, you'll be able to apply that to other areas of your life and investing and do better on your own, because my process will be different than yours, but fundamentally, they'll probably share the same things. So guys, this is me on Twitter. I'm very active. Follow me, follow Mo, follow Everything Money. Mo, you're real Mustafa H.
Yep.
And Everything Money is E-Money YouTube or Everything Money YouTube. Which one is it?
E-Money YT?
I don't know. Look at my followers. I follow them. We just changed it.
That's
so
why.
Follow me, then follow the others. Guys, let's take a look at PayPal. Mo's going to go over the actual press release from PayPal. They were expected to make $1.15 per share. They made $1.16. They were expected to have 7.27 billion in revenue, and they finished with 7.3. So they beat on both, and they're down 6% right now, Mo.
Yikes.
6%.
That's
down to
crazy.
$69. Now, guys, if you know me and I own this company, guess what I'm hoping for?
Goes down.
A much lower price. Wow. I do not want this thing going to the moon. I want this thing falling because I want to own PayPal at much lower prices. Just remember that. I want you to get to that mentality. If that's a new mentality to you, you need to subscribe to the channel because that's what we're going to teach you, how to root for lower prices. Absolutely, you want lower prices. You want to buy great companies at great prices. I'm not going to buy into the bullshit of great companies at fair prices. I want great companies at great prices. The difference is a great company's great price is going to be a lot closer to fair value than an okay company's awesome price. That's the difference. So I look at PayPal as a big company, 6.5% now, Mo. This is a company that just did 7.3 billion in revenue. In the same quarter last year, they did 6.8. So at $500 million more, not big growth, 7-8% growth, nothing huge. Mo, do you have in here? Oh, there you go.
Yeah, here's some highlights.
There you go.
Net revenues increased 7 and 8%. Let's see here. Let's see, what else do we have? Operating highlights. $376.5 billion in total transactions. That's up 11%. $6.1 billion in payment transactions, up 10%. These numbers are actually pretty incredible to see. For a company that is as mature as they are and now dropping, this is what we've seen a lot during this season.
I just learned in this book I'm reading that the founders of PayPal who founded YouTube.
No way.
I did not know that.
Neither did I.
I don't remember their names, but it was the guys who founded, some of the guys who founded, and by the way, Peter Thiel, who I love, also was one of the original investors in PayPal, and yeah, that's great.
Wow.
Solid performance.
Very solid performance, and the stock price is doing what?
6% right now, down.
We've seen this a lot. We've seen a lot of the beats on top and bottom line, and then the press release looks really good, and the stock
and they're probably going to have a conference call, and they will say something in there, and that conference call could lead to great guidance, bad guidance, and some sort of thing. So, Mo, while I explain some other high-level things for PayPal, do you mind looking at more things and then bring it up, and we'll go through it afterwards?
Sure.
All right, guys. So remember, in this video, we're going to have things for beginning investors and more advanced investors. So no matter where you are in the spectrum, please just stick with us, and we'll go through it. First off, $82.6 billion market cap. What does that mean? If you buy all the shares outstanding at the current market price, that's what it'd take to own 100% of the company. Revenue of $28 billion in the last 12 months, not including this last quarter. Free cash, so net income was 2.7, but look at this, free cash flow of 5. Their 5-year net income, 3.12, free cash flow of 5. Guys, it's very rare to find a company that consistently has more cash flow than net income. That's a very tough thing to find. That's what I like about this, all right? Their 1-year PE is 30.55, but their free cash flow multiple, Tim, can you make note while people are on this? I'm okay with this. We got to add the free cash flow multiples down here. Right above enterprise value, let's do the 1-year free cash flow and the 5-year cash flow multiple. So market cap divided by free cash flow and market cap divided by 5-year free cash flow for those multiples. That way we can compare those. But this is a company right now, $82.6 billion market cap, making $5 billion a year. That's 16 times free cash flow. It's pretty solid for a company that can still has a lot of potential to grow as the world economies expand. They're really good and very reliable, and they're very consumer-based. That's why I like them. Whenever I want security, buying something overseas, what do I pay with?
PayPal.
Actually, whenever I want security, buying something anywhere here, I still like to pay with PayPal. They're very pro-consumer. Decent return on invested capital, not huge. 5 years is 9.6%. 1 year is 10.5, which is about where the market is, but they're still growing, so hopefully that gets better. 50% gross margin. That means every extra transaction, every extra dollar in revenue they bring in, 49 cents goes to pay basically the bottom line before taxes. And the bottom line, look at this. Their bottom line the last year is a lot lower than their 5-year average. So that's something to consider here, guys. Why is their profit margin last year 9.6 and the last 5 years was 14.1? That's interesting, isn't it?
Yeah, it really is.
That explains why their 1-year PE is higher than their 5-year.
Right.
All right, let's go to the 8 pillars here.
Yeah.
Look at this.
Wow.
Yeah.
This is not what I was expecting to see.
Guys, we have 2 X's. One is cash flows down over the last 5 years, and one is the PE multiple. But remember, the free cash flow multiple is a lot lower. Interesting. They're buying back shares. Mo, also, let's look up what their share buyback plan is.
Okay.
They bought back 5.3% of their shares in the last 5 years. Guys, if you remember, look at the stock price. Here's what I don't like about it. Their stock price hit a high of $310 on July 26th, 2021. 2 years ago, it was at $310. It is currently at, after hours, 68.82. That is a drop of almost 80%. And remember, I guarantee there are videos out there from other people saying PayPal, the moon, this is incredible as this is going up. I know we did videos of PayPal back here. We're just like, we just can't make it work. We don't know what to do here. That's why you should watch us as a channel. We don't follow this. We follow the numbers. The numbers will tell us what price to pay as we apply the qualitative aspects of things we like about the company. Mo, go ahead.
So in 2018, the board put forth a $10 billion share repurchase program. And then in 2022, a $15 billion share repurchase program.
So 2022, Mo, the good news is...
Yeah, 22.
They started 22 at 196, the high, but their low was... The low of 2022 is probably around $67, $66. Okay, so they probably bought back some cheap shares if they were buying them back.
Here's the average. Here's the 2022 share price, $85.89.
Oh, there you go.
Average $85.42 average.
Great.
So
a lot better. So guys, remember, we want the companies buying back cheap shares, not expensive shares. When they buy back expensive shares, they're investing in an overpriced asset. It's no different than buying another company that's overpriced. We want them buying back cheap shares. But this is great. This is a company that's, okay, let's look at the analyst estimates, Mo. Analysts expect the company to make $5 a share this year.
Okay.
Going up to $9.22 in 2027.
Pretty good.
Yeah. So right now, the stock stays at $68, and you have it for the next 4 years, assuming analysts are correct, which be careful about that. What's on your mind?
I jumped ahead to revenue, and I was like, damn.
Well, let's see what the revenue is. I'm just going to go ahead and jump. Oh, my lordy.
Yeah.
50% increase in the next 5 years, 4 years.
I think if you showed me these analyst expectations, I would have never guessed this was PayPal.
Remember, exactly. But remember, Mo, analysts have their biases, and we have to be very careful about that.
Yep.
By the way, I want to congratulate us. We just hit 200,000 subscribers today. This morning, we hit it. We announced it on Twitter. We announced it in our community. You know, we said we had 87 on January 1st, 2020. September 15th, 2020, September 10th, we hit 1,000. At the end of 2020, we were 8,700. So we went from 87 to 8,700, and we've been growing ever since. Even though the finance community last year, the average, except for Graham Stephan, we're the only ones I think that gained last year in people with over 100,000 subscribers. Maybe that's not true. Okay, Andre Giek did too. But a lot of them lost because we kept warning about the hype. People told us we were wrong. We think there's still a lot more to go, guys. Valuations just drive everything. Now the stock's down almost 7%.
Wow.
All right. So Mo, anything else that you want to highlight here in their actual press release and their actual what's it called?
Yeah, it's a press release.
Yes,
Earnings
great.
press release. So here is quarter Q2 of 2022 versus Q2 of 2023, and you can just see, I like these comparison charts. The net revenues increased 7%. Operating margins, which is very important, that increased significantly. Look at that increase, 4.32%.
Wow.
That's a big jump.
Yeah.
Now, of course, 11.2 may have been a little bit skewed because margins.
Well, remember,
were
Mo.
crushed last
Yeah, exactly.
year.
That's the thing, Mo.
So-
this might help explain
Yeah.
the big difference between
Right.
profit and the 1 year profit and the 5 year
Right.
profit. It might be just going back to normal.
Right. A lot of those tech companies had those issues. Let's see anything else. Okay, so they did GAAP and non-GAAP down here. So let's see the free
Tax
cash
rate was up a ton.
Tax rate was up a lot. Yeah, a lot. I don't know what happened there.
24% increase in earnings per share. Mm-hmm. Okay, go down free cash
Free
flow.
cash flow.
Oh, they had negative free cash flow there.
Yeah, interesting, huh?
Huh.
And that was a big drop. Big swing.
Can you go find out why there's negative free cash flow?
Sure.
On the non-GAAP. Okay. Well, is that the quarterly one?
No, this is the annual. You want the quarterly?
Well, that's for the quarter, isn't it? Free cash flow for the quarter.
Well, this is over the year.
Is it? No, that's Q3.
Right.
That's just showing so.
But year over year.
Yeah, no. It's showing this is the year over year change. This is what they reported.
You just want to see the quarter?
This is the quarter. They reported negative free cash flow in the quarter.
Okay, let me go look up.
So
the
this last
quarterly.
quarter, guys, they had negative free cash flow. That's interesting. Let's go find out why that is. These are the things. This is the reason why you look at these things. All right, guys. So I'm actually going to go to Write the Stock Analyzer tool. I want to make sure that we analyze the company, we make assessments about the future, and the Stock Analyzer tool will tell us what price to pay based on those assumptions about the future. Now remember, garbage in, garbage out. We like doing low, middle, and high on the companies we do because we want to sit there and give a wide range for them. So what's important here is that we're going to put these numbers in, and it's going to spit out. It doesn't include the balance sheet, so you got to remember that. This only includes assessing the company's cash flow and a discounted version of that cash flow. All right, so I'm going to do a 10-year analysis, and as you know in our software, we can do 1 to 20. And by the way, check out everythingmoney.com if you're interested in the software, but I'm going to do revenue growth over the next 10 years of 4, 7, and 10%. Now, here's why I picked those numbers. 4 is kind of low. The GDP worldwide in the US will probably grow at 4%. They may sit there and say, no, it's only 2 or 3%. That's real GDP. This is nominal growth. Like adding back in inflation. 7's kind of like, listen, it's still a growing company, still has a lot of growth potential. And 10's kind of like, hey, listen, if they crush it and they get 10%, that's awesome. Now, profit margin. As we said here, the 1 year profit margin is a lot lower, but right here, it's about 13 or 14%. Now, guys, look at how different the free cash flow is. Free cash flow in the last 10 years has been 21%, but the profit been 13.6. The difference between these two, profit margin is driven by SEC rules, GAAP, all these other rules, accounting rules, GAAP rules, all these things. Free cash flow, it can still be manipulated, but it's much harder. Cash in, cash out. Cash from operations, less the money invested back in the business is your free cash flow. So for profit margin, I'm going to put in 12.5, 16.5, and 20.5. And you might sit there and say, well, Paul, they never hit 20.5. No, they haven't. But I'm hoping that over long periods of time, profit margin and free cash flow equate out, which means they could hit that 20% number. Okay, now for profit margin, now for free cash flow, I'm going to do 16, 20, and 24. So 20s, it might be a little low for the middle one, but 24 on the high side because, hey, if they start to grow even further with a 50% gross margin, if they doubled their revenue tomorrow, something tells me their overhead wouldn't have to double to get there. Mm-hmm. So they might be able to achieve 24% free cash flow. Mo, go ahead. Were you saying something? Were you looking at me to say something?
No, go ahead.
Okay.
I figured out the cash flow thing, but.
Okay, we'll get to that right before we hit the analyze button.
Yep.
So the PE. Now, guys, this always confuses people. What I like to do is I assume the market average of 15. I'm going to go up or down from there. What makes me go up? Higher revenue growth, higher return on invested capital. And that return on invested capital, for those of you who are new, means they can invest money back into the business and get a high rate of return. The higher they can reinvest and get a rate of return, the better for the company because they can really grow their profit. Their ROIC isn't very high here. It could be because they're still growing, but I'm going to assume this ROIC is correct. So I'm going to go 14, 17, and 20. And the same with the price of free cash flow. And then finally, for desired annual return, guys, very simply, this is your margin of safety. What return do you want? Okay. Now, PayPal is not some conglomerate like Apple or Microsoft. You've seen me sometimes put 10% in here or lower, 9%, 8%, because the bigger the company, the bigger the moat, I don't need as big a return. The bigger the risk, the more potential things that can go wrong, I need a higher return. And as I make higher assumptions, I need a higher return. So for this one, I'm going to put in 11, 13, and 15%. Okay? Because I can get 9 or 10% from investing in a long-term ETF, and PayPal isn't just a no-brainer company. There's a lot of competition there. So let me hit the Analyze button. Again, we're not going to go there yet, but it's further down. It's now down 7.35%.
Yeah.
All right, guys, so I've hit the Analyze button. Let's go see right here. All right. We got a low price of 43 to 55, a high price of 101 to 120, and a middle price of 68 to 83. Now, it's currently my watch list at $60. I'm probably going to increase that here. But if you paid today's price, that's what this current price return is. If you paid today's price based on a free cash flow method, you'd make about 7% return if the low assumptions occur. If the middle assumptions occur, you'd make 15%. If the high assumptions occur, you'd make 22%. Again, assuming you're paying today's price. So guys, this might be interesting. It's on my watch list at $60. I'm actually going to put it at 65. And here's why. I already bought shares along the way. So I have it on my watch list. It's going to notify me via email and on my phone immediately telling me, Paul, PayPal hit $65. Go get ready. Where's it at right now? 7.24% down. And it's on my watch list at $65. All right. So guys, we appreciate you watching the video. Please subscribe to the channel. It's very important for you to learn the analysis and the process we're trying to teach. Again, I own this company, but don't buy just because I own it, because you're not going to know when to sell it if all of a sudden something happens and goes away. So please learn the process. Join us to learn the process. It'll make you a smarter investor. Take care.